Index funds and exchange-traded funds sound similar, but they are very different and serve very different types of investors. We'll look at each in a simple way so you can understand what they are and their advantages and disadvantages. First, we'll cover index funds, followed by exchange-traded funds. Both types aim to solve the same problem of how to invest across assets efficiently without picking them individually. The differences are in how they're managed, how they trade, the costs, and who they're designed for. First, we need to understand what a fund is. Essentially, it's financial assets, also called securities, which are grouped together. To understand each type properly, we'll start with the foundation on which they are built, which are stock indexes. A stock index is a statistical measure designed to track the performance of a group of stocks. Instead of looking at individual stocks, an index aggregates price movements across many companies to show how a market, sector, or asset class is performing. The first widely recognized index was made in 1896 when Charles Dow introduced the Dow Jones Industrial Average. Over time, broader indexes emerged, such as the S&P 500 for U.S. stocks or the FTSE 100 for UK stocks. Today, indexes exist for almost every corner of the financial markets, including stocks, bonds, real estate, commodities, and more. Indexes themselves are not investable, as you cannot buy them directly. Instead, financial products were created to track indexes and give investors exposure to their performance. That's where index funds, exchange-traded funds, mutual funds, and hedge funds come in. Unlike an index, you can invest in an index fund which is designed to follow the performance of an index. They hold the same securities as the index they track and in the same proportions. Next, we'll look at the major advantages and disadvantages of index funds. Firstly, because they are passively managed, they do not require teams of analysts to make buy and sell decisions. This simplicity leads to one of their most significant advantages: a very low costs. Expense ratios for index funds are often a fraction of those charged by actively managed funds, and over long time horizons, the lower fees compound into significantly higher net returns. Secondly, they provide broad diversification. A single fund tracking a major market index can give exposure to hundreds or even thousands of companies across multiple sectors. As a result, it reduces company-specific risk, making index funds especially attractive for long-term investors. Another advantage is predictability and transparency. Investors always know what an index fund owns and how it should perform relative to its benchmark. This makes it easier to set expectations and evaluate results. However, there are also some disadvantages. The main limitation of index funds is also intentional, which is that they cannot outperform the market. They will rise and fall with the index they track. During market downturns, index funds decline along with the broader market, with no active manager attempting to reduce exposure defensively. Despite this, extensive academic research shows that, after fees, index funds often outperform the majority of actively managed funds over long periods. This is why many experienced investors advocate it as the core of a long-term portfolio. Overall, the management is passive, costs are very low, and the minimum investment is usually low. Also, it's easily accessible to the general public. Tax efficiency is typically good, and transparency of what's in the fund is clear. Exchange-traded funds, also known as ETFs, were created to combine the diversification of mutual funds with the flexibility of stock trading. An exchange-traded fund holds a basket of securities that often track an index and trades on a stock exchange like an individual stock. Firstly, they have low expense ratios, particularly when they track indexes. Like index funds, they benefit from passive management and minimal turnover. The next advantage is broad diversification across many markets, sectors, countries, and asset classes with a single trade. However, not all exchange-traded funds are equally diversified, and some, like sector-specific ones, can be highly concentrated and volatile. Another advantage is tax efficiency. Both ETFs and mutual funds can pass capital gains onto investors each year, which can reduce returns. However, ETFs usually distribute far less capital gains compared to mutual funds. This is mainly because exchange-traded funds use a tax-efficient process called in-kind redemptions when investors close their position. This allows them to meet redemptions without selling securities and triggering taxes. ETFs are also traded on stock exchanges, so most investors buy and sell ETF shares from each other. Mutual funds don't work this way, as investors can only buy or sell directly with the fund, and all transactions are done in cash. When investors withdraw money, the fund often has to sell investments to raise cash, which can trigger capital gains taxes for everyone in the fund. First, despite broad diversification being an advantage for some, it can also have a downside as you can't customize the holdings within the exchange-traded fund. If you think a particular stock or sector will underperform the others, you cannot remove it. The following downsides relate to behavioral risks, as exchange-traded funds allow intraday trading, which may tempt investors to trade frequently and react emotionally to price movements. Also, there's a greater risk of misusing leverage, and leveraged exchange-traded funds in particular carry significant long-term risks due to compounding. Some very advanced and experienced traders may find day trading and leverage advantageous. However, it's a disadvantage for most people. Compared to index funds and mutual funds, the management is passive and costs are very low. The minimum investment is low, and it's easily accessible to the general public. Furthermore, tax efficiency is excellent, and the transparency of what's included is high, which makes it a great option for most investors. Overall, exchange-traded funds have become one of the most popular investment vehicles due to their flexibility, transparency, and low cost. If you're learning something new, please consider clicking the like button and subscribing so you don't miss out on more videos like this. Index funds and exchange-traded funds offer low-cost diversified exposure and are ideal for most long-term investors due to their simplicity and accessibility. Choosing between them depends on your goals, risk tolerance, time horizon, liquidity needs, and willingness to pay for management. For most investors, a simple low-cost index fund will outperform most mutual funds or hedge funds over time, as numerous studies have shown. Understanding how each works helps you build a portfolio aligned with reality rather than marketing promises. The key is not finding the most sophisticated product, but rather in choosing the one that best fits how you want to invest. As we went through a lot, leave a comment if you have any questions and I'll be sure to reply. If you learned something, please consider clicking the like button and subscribing. You'll find this video useful to watch next. Thanks for watching and see you in the next one.